Thanks for joining the Savvy Ladies Wednesday Wisdom webinar. I'm Maggie Montemuro, and I'm the Marketing Manager at Savvy Ladies. I would like to remind you that if you have any questions during the webinar, you can type them into the chat box. If you're joining us by phone, you can email your question to info@savvyladies.org. Today's presenter is Barry Newman, Principal of Trausk Solis. Barry is a certified public accountant and the head of Trausk Solis Certified Public Accountants, LLC. He has over 35 years of experience providing tax and accounting services for individuals and private businesses. Barry is a member of the American Institute of Certified Public Accountants and the New York Society of Certified Public Accountants. Thanks for being with us today, Barry, and I'll hand it over to you.
Good. Okay. Thank you, Maggie. Hello, everybody. Of all the things that you have to deal with in going through a divorce, taxes, while they don't seem important, often enough are very much so. And so I'll go through certain things that I feel are of importance to the people who may be contemplating divorce, going through it, etc. One is the filing status, very important. The marrying filing joint versus separate, it depends on the marital status and or unusual situations. Now, almost always it is best to file married joint, that the tax tables are a lot more generous. However, there are things that may come up that may cause you to file separately. One of them being if one of the spouses has a very large medical bill. But the other thing where divorce comes into play is a concern over what liability one spouse has that the other is unaware of. So if the husband has a closely held business and the wife is unhappy with the reports that she's been getting as to what it is worth, what's been done, and that there may be some possible tax liabilities, it's going to be best to file as married filing separate so that it's a separate return and the wife is not responsible for whatever problems arise from the husband's dealings. Now, that's the cut and dry version. There's such a thing known as the innocent spouse rule. So, for instance, if the joint return has been filed all these years, and then IRS comes up with a big fat tax liability, and it's strictly from the husband's perspective because he's the one who earned the money. Again, I'm giving a textbook example. The innocent spouse, meaning the wife in this case, it can have some relief. Now, to qualify this, they have to have filed a joint return for the year that has an understatement of the tax due to the erroneous items. They have to establish at the time of the signing that the return that the taxpayer did not know or have any reason to know that there was an understatement of tax by the spouse, and they have to show that it would be unfair to hold the innocent spouse liable for the understatement of tax, taking into account all facts and circumstances. Now, that being said, a lot of people are going to fall into this situation here a lot of the time, and I'm using husband and wife in the way I'm using it just for the purposes of presentation. If the husband has a business and the wife has trusted him all these years, and all of a sudden IRS starts digging in, often enough the wife is unaware of a lot of the things that took place. So that's where the innocent spouse rule comes into play, and it's very important that people keep aware of that. Now, one of the other things that comes up when you go to single or head of household, it depends on whether or not the taxpayer is supporting children and or parents. Now, to be a head of household, you have to provide more than half the support of a child who lives with you or a parent who does not have to live with you. So if you have elderly parents that you're paying more than half their support, they can live in their own place and you still will get the head of household status. The advantage to that is that the tax rate is less on the head of household than if it's single. But the very important thing comes into play with these filing statuses has to do with If a husband and wife are living apart for more than 6 months in a calendar year, and there's a dependent child, okay, the one who is providing more than half the support and, well, mostly the one who is living with that child, let's say the mother, okay, can claim as a head of household even if they are still legally married at the end of the year. Now that's very important because that's a better filing status than married filing separate and could amount to a big difference in money being saved. So that is it pretty much on filing status, the things that come up on a regular basis. Okay, next page, alimony versus child support. This is always a bone of contention. Alimony is deductible by the payer and reportable as income by the recipient. Child support is not deductible by the payer, nor is it reportable as income by the recipient. How the agreement should be structured depends on a number of different factors. Okay, if the husband's income is a lot higher than the wife's, alimony will give a larger tax benefit to the husband, and the wife will pay less tax on receiving it. So let's just say that the alimony is $100,000 a year. If the husband is earning $500,000 a year, he's going to be in a top tax bracket, and he will save federal, state, and city tax about 50% in tax on that. So the $100,000 in alimony will only cost $50,000. Whereas if the wife is collecting the $100,000, you take into her deductions and whatever else they may be, she may very well only be in a 30% bracket, costing her $30,000 in tax. So that's why the alimony is going to be a benefit to the husband, doesn't cost as much for the wife, and that scenario there works best under the circumstances that I just said. If there are children involved, often enough there's a piece that really needs to be considered child support based on what monies are being paid. This entire thing is where a matrimonial attorney or a mediator or whoever, or a divorce coach, whoever people are working with, can help and talk about this based on everybody's circumstances are different. It may be that you have both spouses working, and that's how things have to be considered, that it's going to be different than if only the husband is working. Okay. All right, investments. A very important thing that comes up with investments is, especially you take a year like last year, while there were capital losses of some substance. I had a case with someone back in 2008, which was a horrible year for the market. The husband sold $1 million in security. Well, there was $1 million loss. So you can only use a $3,000 loss in any 1 year. The rest has to be carried forward. The divorce agreement was almost signed when I looked at it and said the wife is entitled to something, even though it was his money as far as that's concerned. The attorneys immediately agreed that 25% of that amount would be allowed for the wife to use going forward. So starting in the subsequent year, 2009, $250,000 loss was recorded. She's able to have up to $250,000 in capital gains without paying any tax on it. So that is significant. Okay, real estate. All right, often enough the house that husband and wife are living in jointly, and a decision needs to be made as to who's going to keep the house, if it is going to be sold, and who will benefit from the income tax deduction of mortgage interest and real estate taxes. Now, if it is agreed upon that the husband is moving out and the wife will continue to live in the house, that's one of the assets that goes in her column in dealing with division of assets, which I'll get to in a little bit. It can be decided that the wife will keep the house, get the mortgage interest and real estate tax deduction, and the husband will just be paying the alimony, which it's deductible whether he pays alimony or he pays the mortgage interest and real estate taxes. If it is best for the husband to pay everything because he will get the deduction, whereas the wife will not get the benefit of the mortgage interest and real estate taxes, it may be best that he reduces the amount of alimony that he's paying and agree to pay the interest and taxes on the house. There are many different ways that this can be agreed upon, dependent on the number of children, depending on how long they have the house. But sometimes there is no way that they can properly segregate the assets if the house is the biggest asset that a lot of people have, which is very common. And the only way to deal with it is to sell it, split the proceeds, and then each of the people buy their own property. Those are the main issues regarding real estate, but there's many different versions of how this can be done. Okay. As I mentioned, division of assets when determining who gets what, there's what's called equitable distribution. And where that comes into play, the easiest one it has to do with retirement assets. So let's say that there's a house worth $1 million and there's an IRA worth $1 million. So the house they have each have, they're going to sell it and keep the money, so they each get $500,000. The retirement assets, if they say split it 50-50, they have to take into consideration that at one point in time, this money will have to be taken and there will be a tax element on there. So to just use the example of where the wife is getting $500,000 of the husband's retirement assets, it's not worth $500,000 in determining who gets what. It is really only worth $300,000 or $400,000 because there is going to be a tax paid at some point down the road. Very important, because otherwise assets that won't have a tax effect are worth more than those that will have a tax effect, and make sure that people don't get shortchanged in the splitting. Okay. Life insurance. When the amount of alimony and or child support is agreed upon, the taxpayer is often enough required to keep in effect a life insurance policy to cover the payments for the duration of the agreement. So let's just use it's $100,000 a year for 10 years. Then $1 million policy would be in effect, and at the end of a year, the husband in this case can reduce the death benefit to $900,000, and then each year, so forth and so on. This is done to avoid the wife, if the husband dies, if the wife didn't get all the money from the alimony, it saves her from having to go after whatever other assets the husband has. It's good for everybody to do that. So again, there's a lot of different ways to do this, come to some compromise over the life insurance, that kind of thing. So I think in a nutshell, that is everything that I have to talk about where taxes are an issue that can be affected when going through a divorce. And a very important thing is the accountant should be involved at the very beginning, because as you can see with just the few items that I mentioned here, it can amount to a significant difference in money as to how things are split. Any questions at this time?
Thanks, Barry. I just want to remind everyone that if you do have any questions, you can type them into the chat box or email info@savvyladies.org. And we had some questions that came in already. So this first one here is, how do I determine my filing status? Is there a certain calendar date that determines my marital status as joint or separate?
Well, married filing joint or separate is based on what your situation is at the end of a calendar year. So if during the year you're still married and there weren't any children, you would be considered married filing separate if you didn't want to file joint with the husband, because if there aren't children, we can't use the head of household status, as I said before. So that's where the difference comes into play. If the people are not living together for over 6 months and there's a dependent child, the one who is housing the dependent child gets to claim head of household, which is a much cheaper rate than married filing separate.
Okay, thanks. Another question that we had come in is, last year I was supposed to claim my children on my tax return, but my ex filed first and claimed them. Besides filing first this year, is there anything else I can do about that?
What ends up happening is if the parties are not able to come to an agreement, well, I'll back up. If the wife was supposed to claim the children and the husband claims them, then, and obviously the husband files first, it can be an issue where the electronic filing will bounce. So what I've done with people where they couldn't come, where the husband wasn't cooperating, is paper filed the return and included a copy of the divorce agreement showing that the wife was entitled to the deduction.
Okay, thank you.
Okay?
Mm-hmm. And another question that we had come in is, are there any special forms that I'll need doing my taxes the first time after my divorce?
It's the same basic tax return, a 1040. If the recipient is collecting alimony, it's just an easy spot on the tax return to report it. But the tax returns are basically the same, claiming whether it's head of household, married, head of household single or married filing separate is it's the same tax forms.
Okay, great. Another question is, can any legal fees during my divorce be deducted on my tax return?
Unfortunately, only the fees that have a tax effect are applicable. So it's important that the attorneys break out in their bills what is being done to work up tax projections, which, obviously are a very important factor. And that portion of the fees are deductible. However, unfortunately, they fall into the category, those fees fall into the category of miscellaneous itemized deductions, and there are limitations which may reduce or even prevent getting a tax deduction for it. It's unfortunate the way that's written.
Okay. Another question that came through is, does the length of the marriage have any impact on how taxes will be handled after a divorce?
No, definitely not. From a legal point of view, when people are married a certain amount of time, the wife is entitled to a certain amount of money at a minimum. And as far as the length of the divorce agreement may very well be affected by how long they were married before. Those numbers I really don't have offhand. That's where an attorney would have to come in. But it does not change the taxability at all.
Okay. Another question here is, would there be a difference if I went to court or settled out of court on my divorce concerning my taxes?
No. Whatever the final agreement is what will govern.
Okay. And another question that came in is, I'm going through a divorce right now and we're working out custody of our children. What do I need to think about for my taxes when deciding if we'll have joint custody?
Well, if it's joint custody, there has to be a decision as to who will claim the children. Now, if there are two children, it's easy enough for each of the spouses to claim one. However, only the parent that has the children in her house will get the head of household status as opposed to a single status going forward. But as to who claims the exemption for the child, it's who's providing more than half the support is the general rule. So that's part of the bargaining that goes back and forth over child support, how much is alimony, and who gets to claim the children. That's one of the sore topics that comes up.
Okay. And do you have time for one last question here?
Sure.
Okay. The question is, are there different equitable distribution rules for different states?
That I don't know. That's really more a legal thing because it doesn't change the taxes. It will, there are um, some states that have community property. Some do not, so that could be a key issue there. But that's a more legal issue. It really doesn't have an effect as far as taxes are concerned.
Okay. Well, I want to thank you again, Barry, for a really great and helpful presentation. I want to thank everyone who joined us today, and thanks for taking the time to answer all our questions. And we hope that
Terrific.
everyone will join us again. And thank you again so much, Barry.
All right. Take care. Take
Thank
care,
you.
everybody.
Bye-bye.
Bye.